Hello, Anthony here from Bulk Mortgages, and in this video today we're going to be talking about getting a mortgage as a self-employed person and a first-time buyer. Essentially, a self-employed mortgage is exactly the same as an employed mortgage. The only difference being, when you're employed, the lender would want to see the last 3 months worth of payslips or your most recent employment contract. When you're self-employed, however, there are a couple of different documents that the lenders will want to see in order to get yourself agreed. Because being self-employed can be set up in a few different ways, depending on the way your business is set up, lenders will assess things slightly different. If you're a sole trader, the lender will want to see a minimum of 1 year's accounts. However, the majority of lenders would want to see 2. The more income you have being a sole trader and showing that your consistency in earnings, the easier it is to get a mortgage and the more options you have. Getting a mortgage as a limited company director. So if your business is set up as a limited company, lenders assess this slightly different as being a sole trader. So the way it would work is most lenders would allow you to calculate your affordability based on the dividends you've withdrawn from the company and the salary you've paid yourself. There are, however, some lenders that will allow you to use the net profits that the company's earned last year and the director's salary. Doing this way tends to give you a slightly higher borrowing depending on how you've set up your accounts. Proving your income for a self-employed mortgage. As we mentioned earlier, the main difference between an employed mortgage and a self-employed mortgage is how you prove your income. The documents the lender would ask for massively depends on the way your company is set up. If you're a limited company director, lenders would want to see the last 2 years' company accounts. So accounts that have been done by your accountant that prove the earnings for the business over the last 2 years. They'd also want to see an SA 302 and tax year overview. If you're a sole trader, they would just want to look at your SA 302 and tax year overview. Lenders would also want to have a look at the business bank accounts. So if you're a limited company, they would like to look at the last 3 months worth of business bank accounts. Some lenders will also want to see an accountant certificate. This is a formal document that the lender will send through to your accountant so they can verify the income that you've earned and verify that what they've got down on your accounts is also the same that they have on their records. How many years accounts do you need for a self-employed mortgage? The short answer is, the more accounts you've got, the easier it is to get your mortgage. We work with lenders that can get you agreed for your mortgage even if you have your 1 year's worth of accounts. However, if you have a second and third year, it gives you access to a broader market of lenders and potentially saving you money on the interest rates. If you have 1 year's accounts, you may need to work with specialist lenders, as your standard high street lenders may be reluctant to lend if you do not have consistent proof of income over a longer period of time. Although it does limit the lenders you've got access to, it is still possible to get a mortgage with 1 year's accounts. If you have 2 or 3 year accounts, a lot more lenders are willing to lend to yourself because you've got a clear, consistent proof of income and they can see a broader picture of how the business is performing in the fact that you've got 2 years proof that the business has turned over a profit.